Adjustable rate mortgages. So we're going to have a discussion on adjustable rate mortgages. This particular part of the presentation is going to give an overview of adjustable rate mortgages. We call them ARMs, A-R-M, and explain how ARMs work. And I'm also going to discuss the issues that borrowers may face when they get an adjustable rate mortgage. So an adjustable rate mortgage frees lenders from being locked into fixed interest rates for the entire life of the loan. So if a borrower gets a fixed loan, that's the same rate for the entire loan. But with an adjustable rate mortgage, the rate is going to adjust up or down depending on the index, and it frees the lenders from being locked into a fixed rate for the life of the loan. So there may be times where the payment is higher. There may be times where the payment is lower. In an ARM, the interest rate may adjust according to the terms of the note, the promissory note, and it reflects the current cost of money, meaning what's going on in our economy today. ARMs are popular alternative to financing tools, as many help borrowers qualify more easily for a home, or even help them to qualify for a more expensive loan, because usually with an adjustable rate mortgage, the rate starts a little bit lower than with the fixed rate mortgage. Many lenders like ARMs because they can pass the risk fluctuation on to the borrowers instead of absorbing some of that themselves. So that's why lenders prefer or like ARMs in certain situations. So what is an adjustable rate mortgage? An adjustable rate mortgage or an adjustable rate loan is sometimes also referred to as a variable rate loan because the rate is variable. It goes up or down. The interest on the loan varies up or down over the terms of the loan depending on the money market conditions and the agreed upon index. So there are several components to an ARM. One is called the index, and the index is what's going to determine if the rate is going to adjust. And we'll talk about that a little bit further shortly. The interest rate on the ARM only changes if the chosen index changes. That's the only time the interest rate will change. The borrower's payments may stay the same for a specific amount of time, maybe 1 or 2 years, and depending on the borrower's agreement with the lender, they're going to determine the adjustment rate period when the loan or the payments are going to adjust. There are several components of an ARM. We're going to talk about each of them individually, but just to give you an idea of where we're going with this, the components of the ARM, we have the index that determines whether the rate is going to go up or down. We have the margin that pretty much stays the same for the life of the loan. We have the rate adjustment period. That's the schedule of time that the rate will stay the same before it actually adjusts, go up or down. We have the interest rate cap and floor. When you're getting an adjustable rate mortgage, of course you want to know how high it can go, what's the highest your rate can be, but you definitely also want to know what's the lowest it can go as well, and that's the floor. And you want to know if it has a conversion option. A conversion option means it has an option to convert at some point from an adjustable to a fixed. So these are the main components of an ARM, and we're going to get into discussion with each of them in just a second. So let's talk a little bit about the index and the margin. The index and the margin. The index is an economic measurement that's used to make periodic interest adjustments on adjustable rate mortgages. Again, the index is the part that determines whether or not it's going to adjust up or down. Although the lender chooses the index that will be used, the lender has no control over the measurement. The lender can decide what index is going to be tied to the loan, but they have no control of when it goes up or when it goes down at any given time. That's out of their control. The index is often referred to as the cost of money. That's a term that's used to describe the index. How much is the money cost? And because of market forces, the index fluctuates during the term of the loan, causing the borrower's interest rate to either increase or decrease. That's the whole reason why it's called an adjustable rate mortgage. It adjusts. But you need to know what is the basis that it adjusts on. It adjusts based on the index. The fully indexed rate is a combination of the index and the margin. See, the rate is made up of the index plus the margin. When they add those together, that determines what's called the fully indexed rate, and that's the actual interest rate that the borrower will be paying. The plural of index is indices, not indexes. So you want to know that term. The plural for index is indices, not indexes. The index is also shown on the loan estimate. They have to give the borrower what the index will be on the loan estimate, and the index also appears on the promissory notes. So make note, two places that you will see the index is going to be specified on the loan estimate, the LE, and it's also going to be specified on the promissory note. The index is not under the control of the lender. I said that just a few minutes ago, but I want to make sure that you understand the index is not under the control of the lender. It's determined by the market conditions, what's going on in our economy. Here are some common indexes or indices that you will hear about. CMT, that's called the Constant Maturity Treasury. There's also called COFFEE, that's the 11th District of Cost of Funds. LIBOR, the LIBOR Interbank Offering Rates. CODI, Certificate of Deposit Index, and one of the most popular ones that you'll learn about is prime, the prime rate. You hear that a lot. A lot of the banks actually go by prime. Those are just the different names of some of the common indices that are out there in the industry. Let's talk a little bit about the margin. Now, the margin is the number that the lender adds to the index to determine the actual rate. The margin. A margin is sometimes called a spread. It's actually the profit that the bank makes. The index plus the margin equals the fully indexed rate. You hear me say that over. How is an adjustable rate determined? How do they determine what the rate actually is? It's called the fully indexed rate. The index plus the margin determines what the rate is going to be. The margin can vary between lenders. The margin is a fixed number. It doesn't change during the term of the loan. It's the actual profit that the bank makes. The margin represents the lender's operating costs as well as their profit margin. The margin is also disclosed on the loan estimate. Fully indexed rate, just want to make sure you get that. How is the fully indexed rate determined? By adding the index to the margin to determine the fully indexed rate. The index plus the margin equals the fully indexed rate. So say we have an index of 4.25 and a margin of 2%. That means the rate, the fully indexed rate, is going to be 6.25%. You simply add the index to the margin to determine what the fully indexed rate will be. There are going to be several terms that you need to know in dealing with adjustable rate mortgages. Things like introductory rate, start rate, lifetime cap, periodic cap. We're getting ready to go through that section right now. But I want to start with the introductory rate. The interest rate on an ARM at the closing is called the introductory rate. It's the rate that you're starting at. It will be in effect for a period of time, sometimes 1 month, could be all the way up to 10 months, but it's the rate that you're actually getting starting at. A couple of other names for introductory rate. They may call it the start rate because that's where you're starting, or the initial rate, meaning it's your first rate. So whether it's called the introductory rate, the start rate, or the initial rate, it's the starting point. Now, when the introductory rate is lower than the fully indexed rate, they call this a teaser rate. They used to offer these a lot. We're going to, just to get the bar in the door, we're going to give you a rate of 0.5% or 1% just to get you going. That's not your real rate. It's going to go up, but this is just to get you started, a teaser rate. You won't see that very often anymore, but you need to know what is the definition of a teaser rate. A teaser rate is when the introductory rate is lower than the real rate, lower than the fully indexed rate. It's called a teaser rate. So introductory rates, whether they're teaser rates or not, they're set by the lender. They're set by the lender. Now, make sure you understand the term rate adjustment period. The rate adjustment period is simply the length of time between the time that the rate is going to adjust. However it was set up. Was it set up to adjust every 6 months, every 6 years, every 2 years, every 3 years? Whatever that period is, that period of time, is called the rate adjustment period. Another term is the cap. The cap is how high or how much it can adjust at any particular time. You don't want to get a adjustable rate mortgage that's starting at 4% and then it's going to adjust to 14%. What's the cap? What's the highest it can go? So to avoid something called payment shock, adjustable rate mortgages have caps. Interest rate caps. A rate cap is a limitation on the amount that the interest rate can increase or decrease at the scheduled adjustment date. There may be several adjustments and several caps, but again, that's what an interest rate cap is. The whole purpose of interest rate caps is to prevent something called payment shock. Like I said, what if you're starting at 4%, then all of a sudden at the first adjustment, it adjusts to 14%. Imagine what that would do to your payment. Wouldn't that put you in shock? That's why it's called payment shock. And the whole purpose of interest rate caps is to avoid payment shock. They're kind of a protection. So payment shock is a significant increase in the monthly payment on an ARM that may surprise a borrower. They don't want you to have any type of shock or any type of anxiety about that. So you want to know your caps. You want to know your start rate. You want to know the highest it can go. You want to know the lowest it can go. You want to have as much information as possible. Caps regulate how much the interest rate can increase or decrease over a given period of time. And remember, what's the purpose of an interest rate cap? Is to prevent payment shock. What is payment shock? A big, huge, or significant increase in the monthly payment that could surprise the borrower. There are 3 main interest rate caps, and we're going to talk about those in the next video. The initial cap, how much can it go up at the very first time? The periodic adjustment cap, how much can it go up each time it's scheduled to adjust? And then the lifetime cap, what's the max it can be before it's capped out? So I'm going to explain all 3 of those to you in just a second. The initial cap, how much can it go up the first time? The periodic cap, this is scheduled to adjust every year. How much can it go up or down each year? How much can it adjust each year? And the lifetime cap, where does it stop? Where is it actually capped out? All right. All right, guys, see you in the next video. So let's talk about caps. In the last video, I introduced you to the different types of caps that are associated with adjustable rate mortgages. Now we're going to go into them in a little bit more detail, and I'm going to show you how to calculate and determine the caps. Lifetime caps, periodic caps, things of that nature. But we start with, again, the initial cap. The initial cap, meaning the first cap, meaning how high it can go, only applies to the first rate adjustment and indicates the percentage points that the rate can increase from the start rate. So if it's the initial cap, it's the very first one, if it has an initial cap. After the initial cap, a loan, an adjustable rate mortgage, can have periodic caps. Now, the periodic caps limits the amount that the interest rate can go up or down at each adjustment period. Again, how often is it scheduled to adjust? The periodic cap, or max, is the most it can go up or down at each adjustment period, each adjustment schedule. For example, if the previous period rate was 5% and you have a periodic cap of 2%, what's the highest your rate can go up or down? Well, if you're starting at 5% and you have a periodic cap that can either adjust up or down by 2%, then the lowest your rate can be is 3. If you're starting at 5 and it can go down as much as 2, that means it can go down to the lowest of 3. But what's the highest that it can go? If you're starting at 5, what's the highest it can go from that start rate of 5 if the periodic cap is capped out after it increases by 2%? The highest it can go is 7. Think about it. You have a start rate of 5% with a 2% periodic cap, meaning it can go up or down, but no more than 2%. So if it's starting at 5%, the lowest the rate can adjust down to is 3. If it's starting at 5, the most it can adjust up to is 7. And at that point, it's capped out. That's what a cap is, the most it can go. Now, the lifetime cap is the most it can go over the life of the loan, and then it's capped out, it's matched, it's at the ceiling. The periodic cap is each time it's scheduled. But when does it stop? That's called the ceiling. The life cap, that's the most it can go over the life of the loan. So when someone wants to know what's the max my payment can ever be on this adjustable rate mortgage, that means what's the ceiling? What's the cap? So the life cap sets the maximum number of percentage points that the rates will increase over the start rate. Remember, you got to start with the start rate over the life of the loan. It's the ceiling. Here's our example. Say you have a start rate of 5.5%. That's your start rate. And a lifetime cap, the most it can ever increase is another 6% over that start rate. That means that the highest that your rate can be on this adjustable rate mortgage is 11.5%. Starting at 5.5, it may adjust every year, every 2 years, every 5 years, however it's set up, but once it adjusts another 6 points from where it started, it's capped out. The most it can be is at 11.5%. Here's our example. You have a start rate of 3% with a lifetime cap of 6%. What's the highest it can ever be? Well, if you're starting at 6 and you're capped out when it goes up, if you're starting at 3 and you're capped out when it can go up at another 6 from where it started, the most that your rate can be on this adjustable rate mortgage is 9%. Now, sometimes adjustable rate mortgages are shown in 3 numbers here. See in this our example here, 526. So I'm going to explain that to you. What if your adjustable rate mortgage is shown in 3 different numbers? Some ARMs allow for higher rates changes at the first adjustment, and then they apply the periodic cap to future adjustments. They're usually shown in 3 numbers, like here, 526. Well, what does the 5 mean? What does the 2 mean? What does the 6 mean? The biggest thing I need you to remember is all of these numbers are from where it started, from the start rate, from the introductory rate. So 5% is the first adjustment. That's where it would adjust the very first time. The first number is the interest rate cap, the most it can go up the very first time it adjusts. The second number is the most it can go up at each scheduled adjustment. Maybe it's scheduled to adjust every 2 years. Well, the most it can go up or down is 2%. Subsequent adjustments. But that last number is the most it can go up from where it started over the life of the loan. Then it has hit the ceiling. And I'll give you an example in just a second. Let's break this down just a little bit further. Sometimes, and more commonly, you're going to only see this in two numbers. Like in our example here, 2/6. Remember, these are caps. When you see it two numbers, just 2/6, the first number indicates the maximum amount the interest rate can increase or decrease at each adjustment period, each adjustment session. However, the bottom number, the 6 in this example, is the most it can increase over the life of the loan. Then it's capped out. It can't go up anymore. So, imagine you have a start rate. Remember, you have to know the start rate of 4%. They may call it an introductory rate, a start rate, initial rate. But whatever it is, it's 4%. And you have a 2/6 cap. That means that the most it can go up or down each adjustment period is 2%. 2% up or 2% down. But the most it can go up over the life of the loan before it's capped out, it can't go up any higher, is 6. So if you have a 4% start rate and it's capped out at 6, the highest your rate will ever be is 10. It's starting at 4. It's capped out when it reaches another 6. 4 plus 6 is 10. But it couldn't go from 4 all the way to 10 at one time. Why? Because it has caps per each time it adjusts. So say it starts at 4%. What's the most it can go up the first time? It can go up 2. So it can go from 6 to 8. I'm sorry, if it's starting at 4, it can go up from 4 to 6. Because the most it can go up the first time is 2. And then say it adjusts again the second time. It's at 6 now. The most it can go up to is 8 because it can only go up by 2 points %. And then say it adjusts again. What's the most it can go up? Another 2. So that's 2, 2, and 2. It's gone up 6 times. It's capped out. It's at 10. It can't adjust any higher than that. It's reached its max. It's reached its ceiling. So let's look at that example again. I'm going to talk about it again. Say you have an ARM, an adjustable rate mortgage, with a start rate of 4% with a 2/6 cap. Remember, the first number is the most it can increase each time it's scheduled to adjust. But the bottom number is the cap, the ceiling. The most it can increase over the life of the loan. Remember, this is from where it's starting from. So you have to know the start rate. The first number, again, is the most it can increase per each adjustment session. It can go up or down, but no more than 2% each time it's scheduled to adjust. So say if we have a start rate of 4%, the most that it can increase is another 6%, and the lowest that it can decrease to is 2%. You're starting with 4. It's scheduled to adjust. If the most it can go up is 2%, 4 plus 2 is 6. But what if you're starting at 4? What's the max it can go down? 4 minus 2 is 2. However, the most it can increase over the life of the loan, the lifetime cap, we go by the bottom number, 6. What's the highest your rate can be? If you have a start rate of 4 and it can increase a max of 6, that bottom number, 4 plus 6 is 10. The highest the rate will be is 10. The last thing that I want to make sure you understand in this section is the floor, the term rate floor. Although rate caps generally protect the borrower, a rate floor sometimes is included in the lending agreement to protect the lender. So a rate floor protects the lender because the rate floor is the lowest that the interest rate can go. So the rate floor is the lowest interest rate in which an ARM can adjust. For loans that are sold to Fannie and Freddie,
it's usually the same as the margin, meaning it can't go any lower than what the margin is. That way, they're making at least some type of profit. So you want to know the cap, the highest it can go. You want to know the periodic cap, the most it can go each time it's scheduled to adjust. But you also want to know the floor. What's the lowest your rate can ever be? All right, guys, I'll see you in the next video.
Let's look at the different types of ARMs. There's several types of ARMs that are available on the market, but I'm going to talk about the most popular ones. There's the interest-only ARM, payment option ARM, convertible ARM, and hybrid ARM. So on an interest-only ARM, it's just an interest-only adjustable rate mortgage. It's where you're only paying a part of the interest for a specified number of years. Usually that's somewhere between 3 years and 10 years. But it's where the interest rate is fixed for the first few years, allowing the borrower to have a smaller monthly payment for a period of time. But then after that time, it's going to adjust. After that, monthly payments will increase even if the interest rate stays the same, because the borrower must start repaying some of the principal and interest. So an interest-only ARM is just like an interest-only mortgage. In the beginning, you're only paying interest. But at some point, whatever is specified, whether it's interest only for 3 years or 5 years or 10 years, after that particular period of time, the borrower will have to start paying on both the principal and the interest. Now, another type of ARM, not as popular anymore, but it was, one of the things that led to the whole subprime mortgage meltdown are option ARMs, or they're called payment option ARMs. They don't do them a whole lot anymore, but you still need to understand it. An option ARM is a type of loan where the borrower can choose from several payments each month. It gives the borrower the flexibility to choose a different payment amount that suits their current financial situation each month. There's usually 4 options. Option ARMs offer a variety of payment options. They will have a minimum payment, but that minimum payment is less than the full payment, so it normally leads to negative amortization. Or if they're having a good month and have a lot of money that month, they might want to make a 15-year payment, or a 30-year payment, or an interest-only payment. They have options. So on an option ARM, a borrower has usually 4 payment options. They can choose the minimum payment, which is less than the normal payment, but the part that they don't pay gets added to the end of the loan, causing negative amortization. They can make a 15-year payment, they can make a 30-year payment, or they can make an interest-only payment. Every month, they can choose a different option. Again, pretty dangerous, because what led to the mortgage meltdown is people paid only the minimum, and the balance on their loan grew, and they had a lot of negative AM, and the loans did something what's called recasting. Recasting is when they look at it all over again, and then they recast or readjust the loan. Option ARM payments were typically adjusted every 5 years. And if they've added too much to the end of the loan, they had too much negative amortization, then that option goes away. Lenders do this by amortizing the higher principal balance created by the additional interest, meaning the negative AM. The automatic payment adjusts, and that particular process is called recasting. It amortizes the loan so that it can be paid in full by the end of the term, because if you have a 30-year loan, regardless of how you made those payments, it still has to be paid in 30 years. So they'll recast it, or they'll adjust it based on the options that the borrower made, and see if the payment needs to go up or down, if the payment amount needs to be recast. Now, convertible ARM. Some adjustable rate mortgages have what's called a conversion option. That means it's a convertible ARM, giving them the opportunity at some point to convert it from an adjustable rate mortgage to a fixed. So if it has a clause in it, a conversion clause written into the adjustable rate mortgage. Because normally to change from an adjustable rate mortgage to a fixed mortgage, a borrower would have to refinance. But if you get an adjustable rate mortgage that has a conversion option in it, you can do that without going through the refinance process. That's already a clause that's built into your promissory note. So you want to look to see, and most borrowers want to see if they have an out clause, a conversion clause, so that they can get out of the adjustable rate mortgage without going through the hassle of refinancing the loan all over again. The lender may charge a one-time fee, but it's much better than refinancing all over again with closing costs and things of that nature. When the loan converts, normally converts to whatever the current prevailing rate is. And hybrid ARM, it's just like a hybrid car. It has two components. It has fixed component and adjustable component. Just like if you're in a hybrid car, it has a gas component, and it may have an electric component. A hybrid ARM is the same way. It's both fixed and adjustable. A hybrid combines the features of a fixed loan with those of an adjustable rate mortgage. A hybrid ARM may be desirable for borrowers who plan to sell their home off or pay their loan off in a few years, because it starts with a lower payment normally, which is the adjustable, but then it's going to convert to fixed. The fixed feature gives the borrower some security with a fixed payment in the initial terms of the loan. The adjustable rate feature and the initial interest rate on these loans are typically lower than what's on the normal fixed rate. And you'll see things, they're usually fixed for 3 years, 5 years. I've seen them all the way up to 10 years. This is how it'll look, a hybrid. It'll say 3-1 or 5-1 or 7-1. The 3-1 meaning it's fixed for the first 3 years, then it's going to adjust every year thereafter. Or if it's a 5-1, maybe it's fixed for the first 5 years and it's going to adjust every year thereafter. The first number tells how long it's fixed for, and the other tells the rest of the period. You've even seen them like these, a 228 or a 327. It's fixed for the first 2 years, but then it's going to adjust for the other 28, and so on and so forth. This type of ARM, the first number shows how long the fixed period is for, and the second number shows the number of years the rate is scheduled to adjust. Before the interest rate on the loan begins to adjust, the borrower can decide whether they want to sell the property or maybe they want to refinance the property 100% up